Welcome to Bloomberg Markets. I'm Marinov. As it goes 12 noon here in New York, you've had one single data point which has reinvigorated the bullish case. The jobless claims come in at 233,000. That's the biggest drop in a year. So it's not a bleed in the jobs market. That is what BMO say to us. As far as markets are concerned, equities are bid up 1.8%. BMO say it's no bleed. Cathie Wood, we know, has been stepping in and buying some of these tech names. Nvidia is up 4.2%, but it is still down 27% from its high. The Nasdaq is still in a correction. Sprues have never quite made it to that correction territory. The Nasdaq is officially in a correction, hence the reason why you see people like Cathie Wood coming in here. The bond auction was shunned yesterday, one could say, on 10s. We're waiting for the 30-year paper results to come a little bit later. Still, the market prices in 100 basis points of cuts. What you've got to ask yourself is whether bonds backing up by 33 bips this week is enough to entice you to pick up a little bit of duration. I take you to the oil market, up 0.8%. Again, we're waiting to see what happens from Iran in their response mechanism to Israel, despite stockpiles shrinking for the sixth week in a row here in the United States of America. That is your cross-asset market wrap. There are some names that are individually moving. Natalia Kanijevic joins us now with the individual movers of the day.
Hi, Manas. So let's take a look at shares of Eli Lilly. They are up today by 7%. The company boosted revenue. Let's start with Bumble while we have a chart, by the way. So this is the worst decline on record. The company's earnings came below expectations. The biggest question for many analysts is, will this revenue model work? Yes, the company did some adjustments. Earlier in April, they upgraded design in order to attract more young users. However, it doesn't look like it's working, and we see that shares are plunging now down by 32%. Let's flip up the board and look at the healthcare movers. We see that Eli Lilly shares are up today on better than expected results, and that's a contrast with Novo Nordisk, which posted worse than expected results a couple of days earlier. And healthcare sector overall is one of the most anticipated in terms of earnings this earnings season. Again, if we look at sales beat across all of the S&P 500 sectors, we see that healthcare is the #1 now. And then finally, retail sector, Under Armour shares are up by 19%. The company beat earnings expectations, boosted outlook across the world. It's a little bit mixed picture. So we see that sales in North America, EMEA region, they came above expectations. Growth in Asia is a little bit slow, but some analysts are still very cautious even on North American market. Now let's take a final look on a bigger picture again, and we can see that this chart shows the cost of protection against a 10% drop in the S&P 500, to be more specific, the largest ETF that tracks the S&P 500, versus the cost of options that bet on a rally, 10% rally in the S&P 500. So we now see that this cost of hedging against a 10% decline is now at almost the highest level since 2022, Mana. So it looks like some traders are still very cautious on the market.
Yeah, there's a vulnerability out there, isn't it? Natalia, thank you very much. Natalia Kanijevic there on the markets. A little bit earlier today, I caught up with RBC's Laurie Calvasina about the next moves for these markets.
The fact that we know that there was something flow-driven, something positioning-driven, that almost makes it a little bit better, right, if it's not entirely fundamental, because I think experienced investors who have done this for many decades know you look for, babies that are thrown out with the bathwater in these kinds of situations. You look for opportunities. And I think that is why it's so important to sort of understand where we're going to stabilize. If this thing breaks 10%, it probably means we're going into growth scare territory.
That is the biggest question, not just of the day, but of the week. Let's bring in Decarley trading founder Carley Garner. Bloomberg Intelligence's Abigail Doolittle joins me around the desk. Let's get stuck into this, Carley, because Laurie Calvasina made it very, very clear there's a vulnerability here. You've called this early. Abby and I were chatting about this. You were prescient. You've called a suspicion in this market. We've had a little bit of a relief rally, but there is still a clear vulnerability to these markets. You're a seller of rallies, aren't you?
Yeah, I believe, yes, I'm bearish on rallies. I believe the bounces can be really big. That's the difficult part about bear markets. And I know it's a little presumptuous to say this is a bear market, but I think eventually that's what we end up with, or at least a really deep correction. And things just feel a little bit off. The complacency is really widespread. It's almost like we're drunk on complacency. I mean, we recently had a decent sized pullback and there was panic in the streets. Everyone thought it was some sort of bloodbath. But if you look at a monthly chart, this is really just a drop in the bucket compared to where we've come from. And also, I've been doing this for a very, very long time. And I think today is the first time I've ever witnessed a weekly jobless claims rally. I mean, this is really just unbelievable price action.
It's funny you're saying that, Carley, and great to have you here with us. I was thinking the same thing. I actually looked twice at the eco data on the Bloomberg terminal. I was trying to figure out what was going on behind this narrative. It is really sort of silly. But when I take a look at the charts, and I know that you are a studier and expert on the charts, the question for the S&P 500, the NASDAQ, is going to be whether or not right now we're looking at the quote-unquote V bottom that would take us higher, or if we're looking at a bearish pause, a bear pennant, so basically a pause before the sellers get back together and take us another leg lower. To me, it looks like the latter. It could all come down to the yen. When we spoke a couple of months ago, you were really tying everything together with copper. So copper now down about 25% from its peak. The yen looks like it's about to take another leg lower. What are your thoughts on these two asset classes and how they tie into U.S. stocks?
You're right. So the copper market really hasn't shown any signs of finding a low. I actually think copper probably bottomed somewhere between 380 and 350. So we're getting closer. But historically, even if copper bottoms, that doesn't mean the stock market's done going down. In fact, usually the two markets lag. When copper tops, stocks follow a handful of months later, and on the bottom, it's the same thing. So if we do see copper bottom out or at least stabilize, that's good news for stocks, but it's not going to be immediate. It might mean 2 or 3 months down the road, things might look a little bit better. So with that said, markets repeat themselves over and over, and sometimes it's even big long-term patterns. Like, for example, when I was in the studio a few months ago, I mentioned the yen carry trade and the potential of it unwinding, and that's what we've seen here in the last couple of weeks. This happened in 2007, and the reason I thought this might happen is that it's almost playing out exactly how it did in 2007. And during that time frame, we saw the yen carry trade start to unwind. We had a big initial push, just like we've seen over the last week or two. The stock market fell over. It's very similar to what we've seen. And then everything paused and stabilized, and people thought, well, it's back to business as usual. But eventually, the yen carry trade turned into a stronger yen, perpetually stronger yen, and stocks started getting really, really heavy. And so I think we're in the first or second inning of this correction. I don't think we're over yet. That said, the meltdown really began around roughly around 54.30, somewhere in that ballpark on the futures market. It's very possible we run up and touch that trend line, maybe even go a little bit higher as we're running stops. So we can get really, really big bounces. But I think that if you're a portfolio holder and you think you felt a little bit of pain this week, take this bounce as an opportunity to de-risk, because there's no guarantee that we don't get another round of selling. In fact, I think that's probable.
And I think it comes down to the cadence and the timing, because if you look at the risk reward over the next 3 to 5 months, it's going to, in theory, be a lower Federal Reserve, a higher Bank of Japan, 30% probability of another hike from the Bank of Japan, which shouldn't come as much of a surprise the second time around. You know, the train has already left the station. So with that in mind, if we break 5,100 on the S&P 500, let's say the yen reaccelerates. I mean, dollars moved up by 5.5 big figures in the past sort of 48 hours. So to a certain extent, that breathlessness has been removed. But if they begin to relock and reload yen longs and we break 5,100, what does that do to the S&P 500? Laurie Calvasina says that's a 14 to 19% potential drop. So we're talking about potentially a bear market.
Yeah, and I tend to lean in that direction. When I chart weekly or monthly stats on the S&P 500, in my opinion, a natural price range would be somewhere between 4,900 and about 4,100. And when I say natural, I'm talking about a natural progression. Markets are built to go higher. That's just how it works, but they're not built to go as far and as fast as what we've seen in this most recent rally. So just a break below 49 puts us into a more comfortable position. There's a weekly trend line that comes in at about 4,700. That's what I'm targeting on the downside. So somewhere between 4,900 and 4,700 would make me feel better. Even as an investor, that's a healthy market. What we've seen on the way up is uncivilized. Uncivilized rallies are followed by uncivilized corrections. So we should expect some good volatility. I will caution, there is a trend line that comes down all the way around 4,000, 4,100. That sounds pretty scary. I don't think that's going to happen, but to be honest, it's not out of the question. So again, de-risking is probably the best game plan here.
And Carley, last time when you joined, if I recall, and you just mentioned 2007 and that we're in early innings, but if I recall last time you joined, it sounded as though you thought we could even go into the 3,000s. Are you taking that off the table? Or one thought that comes to mind to me is the uncivilized rallies. The way I put that is that things go too far, too fast. They go much further and longer than you can think, both to the upside and then to the downside.
Correct. And I would like to point out again that we are extremely complacent here. I've heard a lot more chatter about the market being at a bottom than being at a top. But if you look at a monthly chart, I think there's pretty good argument to be made that maybe we're closer to a top than a bottom. I'm not ruling out the 3,000s. I think it is possible. I don't, with the economic backdrop and everything that we see today, I don't really see it going much below 4,000 at this point, but I could change that, as time goes on and fundamentals change. But even the mid 4,000s, I think, is something that most portfolios are not prepared for. The reality is, based on the reaction that we saw on Monday, the average person is just not equipped to handle a legitimate bear market. And that scares me a little bit because once it starts, it might be hard to stop the momentum. So you're right, 3,000s is not out of the question. I'm not counting on it yet, though.
In 15 seconds, then, stocks are overvalued, but for you, therefore, you must be a buyer, a very natural buyer of bonds. In 15 seconds.
Absolutely. I've been irrationally long treasuries almost my entire portfolio. So that's where I'm positioned. Maybe I'm wrong, but we'll see.
Nothing wrong with a bit of irrationality, or for that matter, a bit of drunken complacency. Decarley Trading founder Carley Garner there, and Bloomberg Intelligence Abigail Doolittle around the desk alongside me. Coming up in the show, a tale of two earnings. The obesity drug competition Novo Nordisk struggles with supply as Eli Lilly pulls ahead in the GLP-1 race. Both stocks are higher on the day. We discuss right here on Bloomberg. Bloomberg Markets has just gone 12:14, and the healthcare sector is in focus. Top performing sector as far as the earnings season is concerned. And today, top spot was Eli Lilly. The shares got a boost after they talked up their revenue and profit outlook for the year. Strong demand from Zepbound. That's their obesity drug. The stock having its best day since, well, this time last year. Let's bring in Madison Muller. She joins me around the desk. Go on the GLP-1s. Good to see you. Why are they having a better day to Novo Nordisk yesterday, in your opinion?
I know it's interesting to compare the two just over the last day. Yesterday, Wegovy and Ozempic missed sales estimates. Today, Zepbound and Mounjaro blew past the sales estimates. So it really comes down to supply. Novo is still really struggling to get a handle on supply of their drugs, while Eli Lilly's investments in boosting capacity are clearly paying off.
How quickly does that supply chain mismatch get? I mean, it takes time to bricks and mortar to build a plant and build a supply chain.
Years,
so that mismatch, does that status quo remain unequal for a period of time, do you think?
We're already actually seeing, because this has been going on for a while, and they're obviously anticipating this massive demand for their drugs. So we are starting to see that Novo's supply is getting better. In the FDA's drug shortage database right now, most of the doses of Wegovy are available now, but it takes time for that to show up in the sales data. And Novo is also dealing with price concessions and rebates given to PBMs, so that's another factor that's sort of dragging the sales down for Novo.
Now, of course, there's another line in the Eli Lilly reading, which is the FDA may act on Zepbound for sleep apnea this year. I mean, this is where you begin to understand the breadth of these GLP-1s. Smoking, obviously weight loss, and now sleep apnea. So I could have cured my sleep apnea, stopped smoking, and not eaten as much when I stopped smoking X number of years ago. This could have been the paradigm shift for me had this been around for me.
It's amazing. I mean, it's interesting to see, one, how many conditions obesity is linked to. There are, it's a risk factor for a lot of other issues like heart disease, sleep apnea, but then there's also all of these indications that drug makers are studying that aren't necessarily related to obesity. So they're looking at Alzheimer's, they're looking at so many other things that they think there might be an independent effect of these drugs beyond just the weight loss effects.
I'll take everything in various sizes. I want to focus in on the big take. Great story today. It's a town not called Malice, it's a town called Bowling in Kentucky. This is a great story, so well done to you and the team. It's 4% of the population in this town has taken Ozempic. And it's the heartland. It's going to be one of the most, perhaps, purveyed set of data, I would imagine. 4% of the town, 74,000 in the town on Ozempic. I mean, it's like the town that, scientists dream of.
Yeah, exactly.
Ozempic town.
Right. It was almost like somewhat of a case study for us to go there and see. We are hearing from CEOs across the board, food companies, from grocery chains, Walmart, everything, saying that they are seeing an impact on sales or expect to see one because of these drugs. And so we wanted to go to this town and go to a place where there are a lot of people taking these drugs and see what's happening. And we found that, the town is changing a lot, but maybe not in the ways that you would necessarily expect. The restaurants are still full. The gyms are still full, but there is like this side economy that's sort of growing around the Ozempic boom, with medical spas cropping up to offer copycat versions of the drugs. The GNC vitamin store is, making a pretty good business off of selling supplements that help with the side effects of these drugs. So it really is changing sort of the fabric of
so it's not all downside in terms of, okay, you might eat a few less burgers, you might not have as many fries, but there is an entire ecosystem around this which can generate jobs. But the question I have, and it was interesting sort of reading through it, it was about your insurance company may well allow you to have it at the start, but then cut you off. Are people jumping that Rubicon?
Yeah, that has really been the struggle, is that, especially in this town, what we saw is a lot of people were on the drugs, and then, 6 months in, their insurance companies stopped covering them because it is quite expensive for employers, for insurance companies to cover these drugs for everyone who might need them, because so many people are potentially eligible for them.
Okay. Madison, thank you. And a great read. I would encourage everybody out there, jump on, have a read at The Big Take. A town called Bowling Green. That's on Ozempic. Coming up on the show, Warner Brothers tumbles a $9 billion write-down on the TV networks. There were green shoots in the streaming revenue, but still the market takes down Warner Brothers in size. Good morning from Bloomberg. Warner Brothers Discovery shares dropping to their lowest level ever. This is after the company took a $9 billion charge, writing down the value of its traditional TV networks like CNN and TNT. Joining me now with a little bit more depth on the story is Chris Palermi. Chris, when you look at the reality check that Warner Brothers have just given us, traditional linear TV, the advertising market is getting hard. People aren't using it the way that they used to do. So is this a kind of truth and reconciliation moment for that part of the business? Is it a sort of Damocles on that side of the business?
Certainly looks that way. That's how investors take it. As was explained to us, the company took a hard look at the valuations of its traditional TV networks. These are ones they just bought in this merger a couple of years ago. And in particularly in light of them losing the NBA rights going forward, their determination was that these networks are worth a lot less than they were currently on the books for. And, that says a lot about where consumers are going and where advertisers are going in the TV business these days.
Do institutions give David Zaslav more latitude? How much time does he have to make perhaps a more radical decision? I mean, I know at some stage they were talking about splitting the businesses up, et cetera. Do you think that performances by the market today shorten the lead time for him to deliver a more radical solution?
We're not hearing anything directly about activist investors or any disenchantment by the board, but you certainly have to believe, given the stock performance since this merger happened, that investors are extremely disappointed, and certainly some must be voicing their criticism to management and the board, because the performance is certainly disappointing.
It's down 70% since that deal went through in 2022, the more than $40 billion deal that went through, which takes me then to the Paramount Skydance deal. We're going to get the numbers from Paramount a little bit later on. But then what goes through my mind is, if you're living in such a tortured world over here in the you know, in various parts within Warner Brothers, what does that set the stage for Paramount? And more importantly, when are we going to actually know what Skydance are actually going to do with it?
Well, I would put these two companies very much in the same situation, both legacy cable TV businesses, trying to make the transition to streaming. And right now, it's not clear they're going to make that migration on their own. And will they find partners? I think David Zaslav on the call yesterday sort of talked a lot about mergers and acquisitions. He didn't quite say his company was up for sale, but he said certainly these are things we're looking at. Paramount obviously doing this big deal with a deep-pocketed investor, the Ellison family, but their strategy isn't all that different than what current management is doing, which is cut costs, try to find partners, and reinvest in content.
Okay, well, it's certainly a crowded market. You just look at your own television when you switch it on, and you just think, I'm paying $9.99 for this, $14.99 for that, whatever, $15.99 for the other. You know, it's becoming harder to differentiate all the time. So it's certainly going to be interesting from a content point of view. Chris, thank you very much. Chris Palmieri there on the entertainment sector, let's just put it like that. I want to check in on markets again as we go to the halftime report here. You've got equity markets taking a breather today, hitting the session highs. Why? On jobless claims, the biggest drop in a year. So that sort of takes some of the heat out of the narrative of this drop in speed of the U.S. economy. BMO says we're on a solid footing. It's not a bleed. We're waiting for the 30-year auction to come through. Will they be knocked back? Because that's hellishly long duration. Yesterday, the 10-year auction, there was slippage there. You're still seeing a little bit of a drop in some of these bigger tech names. Overall, the Nasdaq being down well into correction territory by 12%. You had an uncivilized rally. That's what Carley Garner just said to us 20 minutes ago here on the show. And that uncivilized rally has led to complacency, significant complacency. You have a small bid to these markets, up by 2%. The S&P 500 did not enter a correction. The Nasdaq did. It's quite significantly in a correction. Yes, you got a small bounce this morning in NVIDIA, but NVIDIA is still down over 27% from its high. So it is all about relative perspective. There were buyers. Carley said to us, look, she's not at all assured that this rally will last. If anything, you sell into these rallies, and you may well trade into the 4,700 level. 10 years, you've had this back up in yield. Again, in her view, the bonds act as a pretty significant hedge. Likewise, Goldman Sachs were with me just the other day. Sharon Bell saying 60-40 portfolio, they work pretty splendidly. Relock, reload. You've had a bounce in yield of over 30 bips. Take it. Take it and relock and reload. At the same time, you've got crude up by 1 1/8 this morning. What you've got here is the juxtaposition between waiting for the Iranian response mechanism to the Israel taking out the Hezbollah and the Hamas leadership. And at the same time, in the background, you've got a physical narrative of stockpiles shrinking for the 6th straight week in a row. Either way, what you've got is a relief rally in equities. We're counting down to payrolls. We're counting down to the Fed, along with CPI. This complexity of information will fill or kill as to whether this is a moment of pause and a lack of Goldilocks or a real U.S. recession. And that's what we've been tracking, the executives here on Bloomberg, in terms of their thoughts on the potential for a U.S. recession.
I do believe there's resilience in the U.S. economy.
We do not yet see any sign of having the economy move in recessionary territory.
There have been several calls for U.S. recession. In fact, they've just turned out to be corrections with a resumption of growth.
I do think that we're getting a correction here after a very strong run on the markets, and that might be healthy.
We don't see a recession coming soon or coming. Actually, we think that the economy is still strongly set.
We probably all have to live with more volatility than we are used to. But overall, I think the trend is our friend, and the trend is showing upwards.
Ahead of the elections, obviously, maybe the market is a little bit muted. But all in all, the United States was always a market which was quite resilient.
The U.S. economy is a little bit stronger than people are giving it credit for, and the consumer will come back as the economy continues to strengthen.
The economy will chug along, and we probably won't see a recession.
From the top there, no recession, resilient. It'll chug along. Valentin Marinov is my guest, Credit Agricole, head of G10. FX. Valentin, good to see you. Yesterday, we had the Bank of Japan put option to put a floor under volatility, to take the heat out of volatility. Listening to that stream of CEO consciousness about the state of the United States, they're not talking about recession. They're talking about a fairly healthy economy. Why then is the rates market so hell-bent on pushing every now and then for a 50 basis point cut, and even at one stage this week, an intermeeting cut, which I know has dissipated, but there is this push by the rates market against the normal process of 25s?
Well, it was the cumulative effect of data surprises we've had from the U.S. in recent weeks and months. And I guess the kicker was really the fairly weak payroll number that the last one that we got. And I guess talking to clients as well, focus will likely remain on the outlook for the labor market as a potential precursor of anything that could resemble recession down the road. But to your point, the broader picture in the U.S. still remains fairly robust, resilient. We are not falling off a cliff anytime soon. And I believe that the incoming data, I believe we have retail sales next week. We also have CPI, by the way, and more data to come between now and the September meeting. That could highlight that the US economy, yes, it is slowing down, but no, a recession is not imminent.
Does that still give the dollar preeminence? I look at the dollar moving by 5.5 big figures against the yen. You know, the unwind of the carry trade, JP Morgan say most of it's been done, 3/4 of it has been done. I question that because it's an OTC market and I'm a skeptic, and that's my point of view. Call me old-fashioned. But is it exhausted? Is the carry trade undone? And if it is undone, what is the consequence for dollar?
Well, so the dollar, I guess, part of the story behind the dollar underperformance was positioning, including overhang of carry trades, predominantly longs in dollars versus the yen. And I believe that that bit has corrected significantly. The additional aspect you alluded to, the Fed put, will materialize, but only when the Fed is comfortable with cutting rates. That means that is a situation where they are comfortable that inflation is under control, and indeed that the real economy needs their support. And I'm afraid, and that is corroborated by what the Fed speakers have been telling us really repeatedly in recent days, that the time to really deploy the Fed put hasn't arrived yet. We're going to hear from Chair Powell at Jackson Hole. Hopefully, there'll be more information about how he believes the Fed policy will evolve from here. And obviously, the markets, as you said, are already expecting the Fed put to be deployed as soon as September. The thing is, however, I do believe that the real time when the Fed will be cutting aggressively is not now, won't be in September, potentially won't be this year. We may have to wait till next year to see the exaggerated cuts that the markets are pricing in at the moment. So the time to sell the dollar on the back of that hasn't come just yet.
I mean, we're so liberal, aren't we, with the phrase the Fed put, the BOJ put, but it makes great for TikTok, and it makes great for Twitter. 25 basis points, September, November, December, Valentin, is not a put option. It's just at the money, you know, steady as she goes monetary policy. It's not a put. That does not qualify as a put option for me.
I wouldn't describe it as a put option either. It is the case that if you look at US real rates, essentially what the Fed could potentially be doing is maintain stable real rates, keep the pressure on, try to bring inflation under control, and hopefully not push the economy into a deep recession. That is their strategy. A put, as you said, would imply a more aggressive easing that could ultimately mean favorable and indeed stimulative monetary conditions. And that is not what we are going to get. And I believe the other important aspect of what the Fed will be doing is the forward guidance that we will accompany any rate cut. Those hoping for a Fed put will be hoping for signals of further aggressive easing ahead. And I'm afraid that is not going to be the case. It will sound more like one and done in September, if you want to use that description, rather than a dovish cut, what investors seem to be pricing or hoping for at the moment.
The high yield in the investment grade markets do not flash red to me. The movement higher, let's say, in the yield spread, it's still low relative to pre-pandemic. And I would say until you see a blowout or a pop in those markets, the veracity of a Fed put is challenged.
Well, that is an excellent point. And to tell you the truth, also what you've been playing out just earlier, we've been calling for a recession time and time again, not only us, everyone. We've been trying to really time the recession in the US for so long that it's becoming an ongoing, I guess, story in of itself. And the part of the story is indeed the fact that what we are not seeing yet, and we may not yet see anytime soon, is a notable tightening of the U.S. financial conditions, including wider credit spreads. And a big part of that is the fact that fiscal stimulus, rather than private spending and investment, has been behind that pretty remarkable recovery in the U.S. And until the U.S. is challenged, really, until credit risk of the U.S. sovereign starts increasing, I don't think that the tightening in the U.S. economy will be significant to push it over the edge into a recession.
Valentin, thanks for joining me. Valentin Marinov, the Credit Agricole head of G10 FX. Coming up on the show, Restaurant Brands sets a cautious tone as consumers pull back on their spending. The stock is higher, though, on the day. We dig into the numbers next on Bloomberg. Your Thursday edition of Bloomberg Markets. I'm Marinov here in New York. Stock of the hour, Burger King owner Restaurant Brands. International sales grew less than anticipated in the second quarter. That's just the latest sign of consumer weakness hitting restaurants. But the shares are in the green. The results just simply weren't as bad as feared. Let's get to TD Cowen. Senior research analyst Andrew Charles is with me now. He's got a buy rating on this stock. Andrew, good to see you. If you look at this house, you've got Burger King, Tim Hortons, and Popeyes. I've just had it on good authority from the floor crew that Popeyes is pretty good. But is Tim's enough to carry the bulk of this brand through a tough time for the consumer? Good afternoon.
Good afternoon. So Tim's, and what was interesting about the release is that I put it in two different compartments. Tim's, which is a Canada-based brand, as well as international, did pretty well. The challenges for the brand were really domestic, where it came to Popeyes as well as Burger King, missing our forecasts. And so what I think you'll see is that they talked about the back half of the year, management spoke about the back half of the year, seeing a similar operating environment. And so, the expectation is that the U.S. business will continue to see challenges the back half of the year. We continue to really like the Tim's playbook that's manifesting, as you saw in the second quarter. They're doing a great job, frankly, of picking off the strong parts of the Starbucks playbook around cold beverage menu innovation, PM food attachment, as well as digital offers as well. So, two different parts of the business, performing in two different ways.
So this is about belief in the strategy, isn't it? Back to basics at Tim's. And it sounds from what you've just said, and I haven't had the opportunity to visit a Tim's recently, but you believe in this strategy on the ground, yeah?
Yes. Yeah, no, absolutely. I think that what you saw work for Starbucks in recent years, Tim's is in earlier stages with this. And so I think that things like the flatbreads they did in the quarter, they're now doing energy drinks as well. These are positive parts of the Tim's brand.
I can tell you walk into an average coffee vending store here in New York, and it is pricey for a coffee and a bagel. And this comes down to the point. If I'm noticing what I'm paying for the coffee, the bagel, and a tip, price really does begin to bite at a certain point. We got burger wars on our hands between Burger King and McDonald's. I haven't had a burger since 1995. Just want to say that out there. I wish. I've had plenty of burgers. That's not my problem. But we are in a world of war of burgers. What does that say about the fragility of the consumer in that end of the market?
Yeah. So let's take a step back. Quick service skews more to lower income consumers, and it's been very well documented about the trade down to at home to grocery stores, while the lower income consumer is clearly value seeking as well. What I think is not being spoken about, is really being picked up within our proprietary survey data, is the middle income consumer is looking at value perceptions and looking at fast casual, and which is your Chipotles of the world, your Cavas, et cetera. And what they're seeing is that the value of what you pay for versus what you get at a fast casual restaurant has really converged with quick service. And so quick service is trying to right size that. They're trying to discount more aggressively. It's not necessarily what the franchisees want, just given that they're the ones that are funding these offers. But, it is something that has been benefiting the fast casual category, which has been the bright spot of the restaurant industry so far in 24, and we expect will be in the back half of this year as well.
Tim, sorry, Andy, we're up against the clock. I've got Tim's on my brain, but you quite like their deal in China. I'm just curious, spending $45 million in China, a slowing economy, but again, you say value will win, and maybe that's the thesis of the deal in China.
So what they're doing in China, it's really done by a new senior advisor in the Asia Pacific region, as well as making sure they're providing liquidity as well to their partner there. What we really like about that is the key growth opportunity is Popeyes in China. There are nearly 11,000 KFCs in China. There are 14 Popeyes. And so what they were able to do is take the Popeyes development agreement. They're going to hold on to it for the foreseeable future, and eventually give the 14 stores to a franchisee to develop out the region. That's what we're most excited about as part of that investment.
Okay. Andrew, thank you so much.
Manus, thank you.
Good to have you with me. And I'll get out there to Tim Hortons and experience the product for myself over at TD Cowen. Now, there is another retail brand that we're keeping an eye on, Under Armour. Are you getting your kit? That's the question. The company raised its guidance after a surge in sales amid a firm-wide restructuring. Let's get to Poonam Goyal. She's tracking the stock for Bloomberg Intelligence. Look, they've brought back the original founding CEO. He's cutting and gutting this company back to what it was, I suppose, he dreamed it to be. What does it say to you as an analyst?
He's making progress, so he's putting in the right steps to get the turnaround started. But make no mistake, there's still a long way to go. We're still in very, very early stages. Sales were still down 10%, and they're still expected to be down double digits for fiscal 2025. So there's a lot more room here to grow. And while they're making improvements, the consumer backdrop is still a little volatile, that anything could happen over the next 9 to 12 months.
Where does Plank want to, where does Kevin Plank want to position Under Armour? My perception of it is sort of, it's sometimes in a discount bin. It's not quite that bad, but it is on discount quite a lot. So where does he reposition this product range to? Is it at Lululemon? Who's he taking this product challenge to?
I think he wants it to be a more premium brand. Think of the Nike or the Adidases of the world, just, brands that do discount, but they don't discount aggressively. The mistake that Under Armour made is that it started to discount too aggressively as inventory got out of control. You saw the brand in off-price, the TJ Maxx's of the world, and people got trained to shop at a significant discount. Yeah. They're pulling back on discounts. We saw that with the gross margin expanding 110 basis points this morning, and we expect gross margins to expand up to 100 basis points for the fiscal year. So they're making inroads to making that improvement, but they do need to pull back on promotions. And I think that is the right strategy moving forward to make it a more premium brand.
So I'm just looking at what BMO said. They're signaling a meaningful tone change, which would shift the discussion from being a struggling growth story to an undervalued brand turnaround. So what would be the proof point for you that undervalued turnaround brand is really working? Is it the margins?
Well, the margins are already expanding. Yeah. For me, it's top line, right? I need to see them get top line growth. And right now, we're nowhere near that. And the thing is, Under Armour has tried this in the past before. So this isn't the first time that they're pulling back on promotions to expand gross margin and to build their brand profile. They've done this before and it's worked, but then they've slipped again. So the real question is that this time around, will they make the changes? And then will the changes continue to drive out performance and maintain their brand perception as a premium brand? And I don't think we'll see that just yet. I think we're still at least a year away from that.
Okay, well, they've done it once, and as you said, they can do it again. I'm just seeing here, in terms of the stock, it's up 20.1% this morning. That is the best stock gain since 2018 on an intraday basis. Go Under Armour. Thank you very much, Poonam, for being with me. Poonam Goyal there, Bloomberg intelligence analyst on Under Armour. Coming up, the billionaire Dmitry Balyasny is on a hiring spree. Are you on his speed dial? If not, why not? The hedge fund is expanding. Get your CV dusted off. It's Bloomberg Markets. I'm Marinov here in New York. The billionaire Dmitry Balyasny is on a hiring spree. Help fix the equities trading business. He's dishing out more than $200 million. Are you on his call list? That's all you really need to know. Here's what he recently told David Rubenstein on Bloomberg Wealth about life of a trader.
Like, number one, you want to make sure you actually want to be in this industry. Like, you know, it's a hard industry. There's a lot of ups and downs. And if the only reason you're going into it is because you think you're going to make a lot of money, that's not a great reason. You got to really have a passion for investing, for trading, and you want to do it in your spare time, even if you weren't getting paid for it. So that's kind of number one. And then once you have you decide that that's what you want to do and you have a foot in the door, there's a great podcast recently from Jerry Seinfeld, randomly, where his best advice was just work. And I think that's right on. So, like, once you're in the right industry in a decent firm, you know, just work.
It takes a little bit more than just work. Work, deliver, make sure your returns are there, and what we're paying you, you live up to it. Catherine Burton is Bloomberg News hedge funds reporter. You've met one or two. Yeah, getting the cash out, $200 million. Who are they signing up, and why? Why this pivot? Because that's quite an opening of the purse.
Well, basically, they had a strategy before when they would take younger, less expensive people and train them and get them to a stage where they would be great managers and not cost the firm a lot of money. And they've decided that that wasn't really that successful, and so now they're going to hire more senior people.
Well, they're going after some pretty big fish. I mean, they're going after Point 72. They're going after Citadel. You know, he's going after his own buddies, people.
Yes, well, that's how where a lot of these people come from. They come from other multi-strat firms. And
the payouts, I mean, what kind of incentives are they offering? Because, you know, if you look at those three faces there, what's the differentiation between staying with Ken and going to Steve?
Some of it are cultural differences. Some of it is maybe you get more payout for the profits that you make. A lot of the pay that they give is not guaranteed. It's you have to make a certain amount of money to make the money.
And that's a very healthy incentive. But, you know, in the end of the day, what I love about this world is that the clients actually pay for the hiring and the opening of the purse strings, because it does come down. It gets passed back to the clients.
Exactly. And that's why Balyasny has are hiring fewer people, but hiring more senior people.
And they're paying up for that. Okay, Catherine, thank you so much. Let's make sure that everybody out there's got their CVs dusted off and get the mobile phone for Balyasny. That's it for the Markets edition here. We're on a bounce back this Thursday. It's going to, by all accounts, it's going to be a quiet kind of lull into Friday and Monday. We've got a low point on the data. You're waiting on the 30-year auction. The results to come. We'll bring you that in the next hour. S&P 500 up by 1.9%. Do bear in mind it has not corrected. The NASDAQ has. It's down over 12% from its zenith. You've got a nice bounce in the NVIDIA and some of the big tech. To-year paper, you've got yields just over the 4 benchmark. Back up in yields. Good morning, good afternoon from New York.